A very good evening to all of you. Welcome to practical session number 27 for the year 2024. Myself, Sujit Kakkar. Today is Sunday, 14th of July, 2024. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, we recently started with our WhatsApp channel, and the QR code is available on your screen. So, if you want to join this WhatsApp channel, you can scan this QR code. Otherwise, the link is also available in the description. So, we use this channel to keep you guys updated about our latest videos, schedules, if we have any updates or if we have any offers. So, that is where we will be posting it. So, just to be updated with all these things, if you want to join this channel, you're most welcome. And talking about today's session, it is again going to be the practical application of demand supply methodology. Now, our demand supply course used to be a paid course. We made it as an absolutely free course some time back, and the links are available in the description. The course is available in English as well as in Hindi, both the languages. And whatever you learn from that course, that is basically the theoretical aspect of it, right? What is demand supply, how to apply it. So you'll be learning all the nitty-gritties of demand supply methodology, but the problem is unless and until you get into the practical application of it, you don't get a good clarity how it has to be applied. And that is what we do in these sessions. So every weekend I do a practical session where we take some examples, and to those examples we apply the complete methodology so that you people can understand how to plan trades in a very mechanical and rule based way. Now, all these examples that I share with you, right, whenever they get triggered, we also review them. But whatever got triggered in the past has already been reviewed. So we can straight away start with our analysis for today. So, starting with the analysis, whenever we talk about demand supply methodology, I always say that. Not just demand supply methodology, even if I talk about trading, right? I always say that trading has to be a very mechanical and rule based process. Now, why it should be mechanical and rule based, I have explained this in a video. The title of that video is How to Start Trading. In case you have not yet watched that video, link is available in the description. And again, during the session, if I talk about some videos, if I talk about some documents, all the links are available in the description. So, not to worry, where do I find these videos or where do I find these documents? Just look into the description, you'll have access to all of them. Right. So, coming back to, because trading has to be mechanical and rule based, and that video will help you understand why it needs to be mechanical and rule based and how you should be starting with it, because there is no bypassing that process. Eventually, everyone will have to go through that process. So, the sooner you start with it, the better it is going to be for you. But yes, it is very easy to say that you need to be mechanical, but unless and until you have a good understanding of whatever methodology you're applying, it's not easy to create a trade plan. And especially when you're starting with learning a new methodology, or maybe when you're new to trading, creating a trade plan from the very first day itself is a very big challenge. So what I have done is to overcome this challenge. I have created two documents for you. The first one is called as the trade plan steps. You can also call it as the flowchart or the walkthrough. And the second document is your rule book. So the flowchart basically tells you what you need to do as a demand and supply trader step by step. So all the steps are laid out for you. And all these steps, they have their elaborate rules which are available in the rule book. So by using the combination of these two documents, you can understand how to plan trades very mechanically and very rule based. Now, the rule book that I've shared with you, mind it is a conservative approach, because whenever you're learning something new, it definitely makes sense that you start in a very conservative fashion. But as you start having more and more experience, if you want to make some modifications to it, that can be done, because every trader has a different personality style. So you can adapt this rule book according to your personality style as you start gaining more and more experience. So, what is our step number one? When it comes to planning our trade, the very first step is we need to define our trade purpose. So now the question is, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade, and the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why are we starting with the trade purpose as our step number one? And the reason we are doing this is because when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge is that I have so many time frames available to me. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We again go with a very logical process, and that logic is that the longer I want the duration for the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into four different purposes, and we call them as hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And similarly, monthly income, a trade which can last for a month or few months. Now, very important by definition, I said the daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, I'm very sure all of you would have experienced whenever the market opens, some symbols they'll gap up, some symbols they'll gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that particular trade. So we understand that whenever we keep a position overnight, it has that inherited overnight gap risk which cannot be avoided. And that is the reason my recommendation to all of you is that as a risk management rule, initially early dailies should be done strictly as intraday trades. Before the market closes, whether you're in profit loss, break even, close your position, do not carry it forward for the next day, because we want to follow risk management by not keeping those positions as overnight positions. Now, when we talk about weeklies and monthlies, anyhow, we are not anticipating to get the exit the same day. So here we have no choice, but we will have to keep these positions as overnight positions. But that does not mean that for weekly monthlies we cannot have gap against us. It can happen, but since we are leaning against some bigger time frames, the probability definitely reduces. But as you start having more and more experience, if you want to include even daily incomes into overnight trades, that can be done. This is what my recommendation is. Initially, early dailies strictly intraday. Eventually, if you want to do it, do them as overnight trades, it can be done, and weekly monthlies anyhow will be overnight trades. So my step one is I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now once I have selected my purpose of trade, what is going to happen from the rule book, I'll get to know what time frames I should be using. So if I go to page number 28, we start with the topic which is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames that we use? So we use a minimum of four different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the four different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my four different time frames? And we get the answer from this table. Like in this example, I want to plan monthly income trades. So as a monthly income trader, my time frames will be monthly, weekly, daily 60. Monthly will be the higher time frame, which is used for curve analysis. Weekly will be the intermediate, used for trend analysis. Lower time frame will be daily. That is where we get our SCTS from. SCTS stands for stop loss entry, target, and size. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart. And this time frame can be used for multiple purposes like fine tuning the zone, type 2, type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. So as soon as I'm done with my step number one, I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. Another thing I would like to add here is that on page number 31, the table that I've given you, this is specifically for the NSE market, which is the Indian stock market, because this market is only open for 6 hours and 15 minutes during the day, right? It's open for a very short window. Now, if you are trading markets which are open for longer durations, then you can, oh, just give me a second. Then you can refer to the table that is on page number 32. So whether you're trading commodities, forex, let's say cryptocurrencies, these markets are open for longer durations. That is where this is the table you can refer to. So coming back to our flow chart, step number one was to define our trade purpose. I defined my trade purpose as monthly income trade, and that gave me the clarity to the time frames I'll be using, in this case monthly, weekly, daily, and 60, plus what analysis I'll be doing on each and every time frame. Now I have clarity to it, so my challenge number one is taken care. So now, once you know what time frames you'll be utilizing, we move on to our step number two, and that is our second challenge. And that second challenge is, yes, I do know my time frames, but let's take example of NSE. On NSE, I have over 2,000 companies listed. So humanly not possible that every day I sit and analyze 2,000 companies. So what we need to do now is we need to have a process in place which can help me get a smaller list out of these 2,000 companies, because if I have a small list, I can do my homework, I can do my analysis almost every other day. But every day, if I have to go through 2,000 companies, not an easy task. So, how do we do this? We do this by using certain computer programs, which are called as scanners or screeners. And the way these scanner screeners they basically work is that we input certain conditions into them, that these are the conditions I'm looking for. And then that scanner screener identifies that out of these 2,000 plus companies, which companies are matching with those conditions. And whatever is matching with those conditions, it gets shortlisted for you, and that is how you get a smaller list. Now, the most important thing you need to remember is, irrespective what scanner or screener you're using, whatever results you get, you can never blindly buy or sell those stocks. So the screener is never telling you what symbols you need to buy or what symbols you need to sell. Screener is only assisting in giving you a smaller list out of a bigger list. Once you have that small list, you will have to manually analyze each and every symbol in that list. Whatever matches with your trade plan is an opportunity for you. Whatever doesn't match with your trade plan, you simply skip it. So again, remember, scanner screeners do not give you ready-made opportunities. They just help you get a smaller list, which needs to be matched with your trade plan one by one. Whatever matches with your trade plan is an opportunity for you. Now, a few examples of these scanner screeners. Example one, if you go to my website, you will see under the free tab, I have created some scanners for you. And these scanners are based on some moving averages, and they help you shortlist symbols based on some moving averages. Second example, on my YouTube channel, if you search for scanner, you'll be able to find few videos, different scanners, different logics. You like any of those, you can use that for shortlisting symbols. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis, and you'll be able to find a video on top-down analysis, which can again help you in shortlisting symbols. So these are 3-4 examples, just to help you understand, what are the different ways of doing it. But you're not restricted only to these 3-4 different scanners. Let me show you a few examples before we move ahead. So like I was talking about, that once you go to our website, just give me a second. Under the free tab, you have the option which is stock screener, and here you can see I have HIT, DIT, WIT, and MIT. Because I want to play an MIT trades, I can click on it. I can run the long scan. Just give me a second. Let me do it again. Right, I can run a long scan. I can run a short scan. Now you can see that the long scan is shortlisting only one symbol for me, and the short scan is shortlisting again one symbol for me. Now, like I already said, just because you're getting some results does not mean that I will blindly buy this stock. Similarly, does not mean I will blindly sell the stock. So the job of the scanner is never to tell me what I need to buy or sell. The job of the scanner was to give me a smaller list out of a very big list. And can you see, out of 2,000 plus companies, it just gave me a list of two symbols. So now I only need to analyze these two. Out of these two, if anything matches with my trade plan, I have an opportunity. If nothing matches with my trade plan, then we don't have an opportunity available to us. Now, many times what can happen is this list can be a very small list, like you can see today, or at times it might not even generate a single result because nothing is matching with these conditions. Or let's say, even if you have a list, but you just want that my list should always be a little bigger list, because the more number of symbols you're analyzing, the higher is the probability you might get an opportunity which might match with your trade plan. So in such a case, if you want to have a bigger list, then you can see that I have given 5 different conditions in this scanner. You'll disable the third one, you'll run the scan again, and I'll do exactly the same thing here. Disable the third one, run the scan again. So initially you saw that it gave me result which was only one symbol, but now it is giving me around 58 from here. And if I go to the other one, I'm getting about 5. So we have 58 plus 5, which is 63 symbols to look into, right? So it's not that after disabling those conditions, which is condition number 3, you're getting a list of 500 or 600 symbols. It's still a very small number, which is just about 63, and it can be easily analyzed, I'll say, in about half an hour, 45 minutes. So this is how you can get your list, and this is not the only scanner which is available to you. You can see that once you go to the screener section on this website, you have over 150,000 scanners available to you. Some are based on fundamental analysis. Then you have your top loved, you have candlestick patterns, then you have your range breakouts, bullish scan, bearish scan, then you have your intraday bearish, intraday bullish, crossovers. So you have n number of scanner screeners available to you, and this is just one website. If you do a Google search, you'll be able to find n number of websites, n number of scanner screeners. So wherever you feel is the right fit for you, you can use that to help you shortlist some symbols. So in this example, you saw we got a list of about 63 symbols. Now, once you start analyzing them, there are a few challenges which you will be facing. So challenge number 1 is, what you'll realize is that when you're going through these 63 symbols, many of them, they don't have a quality demand zone or a quality supply zone on the lower time frame. And if you don't have a zone on a lower time frame, you can't plan a trade, because to plan a trade, we need a quality area. And the reason behind this is because whatever these 150,000 scanners we talked about, none of them are based on demand supply zones. They are either based on conventional technical analysis or fundamental analysis. So that is why just because something is getting shortlisted does not guarantee that you'll have a quality area available on the chart. Second challenge is, few of them, even if they have some quality areas available to you, those quality demand supply areas might be far away from the current market price. Now, due to this, what will happen, you'll have a longer waiting period before the prices are back into your zone. And during that waiting period, whatever price action develops, it might even disqualify the trade setup for you by the time it is back into your zone. So these are some of the challenges we face when we have our scanners that are based on conventional technical analysis or fundamental analysis. And to overcome these challenges, I have also created 2 custom built tools. One is called as the alert service. The other one is called as the screener. Now, to have more information about what is alerts, what is screener, the link to the walkthrough videos are available in the description. You can go through those videos to help you understand what these scanners are. But again, I'll add, these are not call giving or tip giving services. These are scanner screeners which are purely based on the formation of demand and supply areas. So do not assume that whatever alerts you're getting or whatever the screener is shortlisting for you, you can blindly buy it or blindly sell it. It's not the case. It is just a way of shortlisting symbols, but now based on demand and supply areas. Now, just to give you an idea, how does alerts they work? So for alerts, we do have a demo channel available for MCX, for NSE, and for few Forex symbols. And once you go through the walkthrough video, you'll be able to understand how you can join the demo channel. So here you can see we have some examples from the demo channel. So on the NSE channel, what we do is we give you alerts for half an hour during the day, and that is from 11:15 a.m. to 11:45 a.m. as per the Indian Standard Time. So you can see on the 12th of July, which was Friday, as and when the zones are getting formed, like at 11:15, we had a zone on JK Cement, which was a drop-based drop on the 60 minutes time frame. This was the proximal value. This was the distal value. Then you can also see we have alerts from 5 minutes at 11:15. Then you have at 11:20 from 5 minutes, 11:20 5 minutes. Then if I further go down, 11:25 on the 5 minutes chart, 11:30 on the 15 minutes chart. So this is what alerts they do. As and when these zones are getting formed during the live market, they keep updating you. And when you get these notifications, you can always go to these symbols on these time frames, and you can match that particular demand area or supply area with your trade plan. If it qualifies, it can be an opportunity for you. If it doesn't qualify, you simply skip it. So again, alerts, they give you live notifications during the live market as and when the demand and supply zones are getting formed. The other tool we have is called as the demand supply screener. And the way the screener basically works is that into the screener, we give our list of symbols. Like here, you can see I've given a list of 40 symbols. Now, I have applied this screener once on the chart. So I'm giving a list of 40. If I apply it twice, I can give a list of 80. I apply it 3 times, I can give a list of 120. And if I use multiple chart layouts, I can give n number of screeners and on n number of charts. But again, Definitely, this also depends whether you have a free account on TradingView or whether you have a paid account. So those limitations will definitely apply. But someone who has a paid account, you can probably apply it a number of times and have as big as a list as you wish to. So what I've done is I have given a list of 40 symbols, and now I have given the condition that out of these 40 symbols, whichever is within 1% proximity to a demand area or a supply area, means when the current candle is within 1% to a demand zone or a supply zone, shortlist for me. So now you can see the screener is telling me that I don't have to go through all these 40 symbols. If you're looking for long opportunities, these are the only three which are within 1% range to a demand area or to a supply area. And similarly, if you want to plan some short trades, these are the only two which are close to supply zones. So example, if I go to TechM, you will see that on TechM will either have a formation of a supply zone or will be very close to a supply area. So let's give the indicator a few seconds to load. So here you can see we do have a supply zone which is coming in from here. So let's give it a few seconds. So here you can see that's where you have your zone. And because the current candle is very close to it, that is the reason it got shortlisted for us. Similarly, if I go to Infi now should be close to a demand area, or we might have a demand area formation on the current candle. So you can see we do have this drop base rally. It was just formed, and that is why it got shortlisted for us. And it can also be applied to different time frames. Now currently I'm on the daily time frame, so it is giving me the results based on daily. If I change my time frame to weekly, now it will give me the results based on the weekly time frame. So that is what screener is. Based on whatever proximity settings you have given, it will shortlist for you. But again, I'll add, irrespective whether you're using the alerts or the screener, they are not call giving or tip giving services. Just because something is getting shortlisted, you can never blindly buy or sell. It is just helping you identify symbols where we are having a formation of a demand area or a supply area, but that demand or supply zone has to be qualified based on your trade plan. So from our step number 1, we got to know our time frames, which was monthly, weekly, daily, and 60. And from our step 2, we'll get a list of symbols, and this can be as simple as I don't want to use any of these scanner screeners. I want a small list. I will only be analyzing my Nifty 50 stocks every day. So you have to decide what process you will be using to get a smaller list, but you need to have a small list, because if you don't have a small list, you can't go through 2000 plus companies or 2000 plus stocks every other day. So wherever your step number 2, whichever way you want to do it, do that. It can be also as simple as you have your own favorite list of stocks, right? So do that, have your list, and now we are ready to move on to the next step. And the next step is we need to go to the lower time frame. So the question is, what is my lower time frame? We got the answer from our step number 1, that as a monthly income trader, lower time frame will be daily. So we'll go to the daily chart, and what are we supposed to do there? On the daily chart, we need to identify zone, and by zone we mean any of these 4 structures. It can be a drop based rally, rally based rally, rally based drop, or a drop based drop. So let's go to our so let's assume we got a list, and in that list, the very first one was ABC, because I don't disclose the name of the symbols while we are doing the analysis. So if I go to this chart, so let's assume that's the very first one which was shortlisted for me. Now, when we talk about demand supply methodology, always say demand supply is a price action based methodology, right? Price action based methodology. Now, what do we mean by price action? Price action means the action done by the price. And what action can price do? Price can only do 2 things. It can either move up or move down. It cannot do anything else. But when price is moving in a very narrow range, we call it as the period of pause, or we can also call it as our basing. Now, initially, when we start learning demand supply methodology, our eyes are not trained to identify these structures. So that is the time we start with a concept which is called as boring exciting candles, because you will see that majority of the zones can be identified based on boring exciting technique. So again, I'm saying most of the zones can be identified based on boring exciting, not every zone. So that is why it is a good starting point to start training your eyes. Once your eyes are trained, then you'll start leaning less against boring exciting. You'll start leaning more against where do I see that period of pause on the chart. Now, just as an example, if I'm looking at this chart and I start from the current market price and start looking down, you can see here we have a nice strong move to the upside. Before that, we have this brief period of pause. And before that, we can see prices were moving down. So if I just talk about what is price action showing me, we moved down, we paused, we started moving up, and that is what we call as a drop base rally structure. So you can see that for demand supply methodology, fact is you don't require any indicators. Once your eyes are trained, you can identify these structures just by visually looking at the chart. But yes, I have a few indicators created for you. Some of them are absolutely free, like your boring candle indicator. It converts all the boring candles into blue color candles on the chart. Yes, the color can be customized. And similarly, the explosive move indicator converts all the explosive candles to black color candles on the chart. Again, the colors can be customized. Now, both these indicators, boring candle and explosive move indicator, are absolutely free indicators. You can use them for free forever. And can you see, even if I was using these two indicators, it is telling me this is where we have an explosive move. Next to it, we have a basing candle. Next to it, we have a exciting candle. So this exciting candle to the left of the basing becomes as your leg in. Basing is always called as your basing. And this explosive candle to the right of the basing, which is definitely an exciting candle, is your leg out. Now, whenever we talk about demand supply zones, they're always made up of three components. Those three components are leg in, basing, and leg out. And now we have identified all those three components, which means we have identified a structure of a zone. And what is this structure? This structure is a drop, base, and a rally. So you can see, irrespective whether I was using price action or I was using boring exciting technique, in both the cases, I was able to identify exactly the same area. Now, if I apply the demand and supply zone indicator, which definitely is a subscription based indicator, you can see it is also identifying exactly the same zone for us. And this is much more advanced because this is not based on boring exciting technique. This is based on price action. And plus, instead of now we finding the zone, it automatically identifies the zones for us. And you can see it plots the zone for us. So the process also becomes faster, easier, and mechanical. But again, I'll add that these tools should not be taken as calls or tips. They are your uh, decision making. These are the tools which are helping you make your decisions. Okay, this is where the demand is, this is where the supply is, so let me see if they match with my trade plan. So always use them in conjunction with your analysis, right? Not blindly. So yes, the indicator has identified a zone for us, so let's mark the zone, which is a drop based rally. And you can see that irrespective whether I was using price action or boring exciting technique or the indicator, all three of them are pointing us exactly to the same area, which is this drop based rally. So once the zone has been identified, which was our step number 3, do we have a zone available? The answer is yes. So once the zone has been identified, you cannot blindly buy at any demand area or blindly sell at any supply area. And that is the biggest mistake demand supply traders they initially do. They find any demand area, they try to buy on it. They find any supply area, they try to sell on it, which is incorrect. Once the zone has been identified, the next step is to qualify it. And for qualification, it is a two-step process. In step 1, we'll qualify it based on certain conditions. And in step 2, we'll qualify it based on the booster scoring. So the very first condition we'll check is that the zone we have identified, can it be a case of level on top of level? Now, why do we start with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different zone. And how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone is getting divided into multiple zones on the lower time frame, we call it as a case of level on top of level, which implies that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if you have a coinciding level, it can be a case of level on top of level. But if you don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame? Now, as a monthly income trader, my intermediate time frame is weekly. So if I go to the weekly chart, you will see that it will identify the zone for us, because I have already given the settings in the indicator that my higher time frame is monthly, my intermediate is weekly, my refining time frame is 60, so that whenever I go to these time frames, whatever settings are to be applied, they get applied automatically. I don't have to make those changes manually. So you can see that we do have this rally-based rally structure. Now you might say it's a red color candle. Why are you calling it as a rally-based rally structure? Because I'm going with the price action. Price action is showing us it's a bullish candle. We paused and we started moving up, and that is how the indicator is identifying it as a rally-based rally candle. Now we though have given you the option that for the leg in, you can select whether you want it based on the candle type. Candle type means bullish candle or bearish candle, or candle color. Now if I change it to candle color, you will see instead of marking it as a rally based rally, now it will mark it as a drop based rally, and the distal line will be shifted here because we have a red color candle, which ideally means a drop. But like I always say, demand supply is based on price action, and price action is showing us we moved up, we paused, and we started moving up, which makes it as a bullish candle. So yes, we do have a zone here. So let's mark this zone, and I'll change it to a different color so that we can differentiate between the two. So the one marked in pink is your intermediate time frame zone. The one marked in green is your lower time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is yes, and that is what we call as a coinciding level. My lower time frame zone is coinciding with the intermediate time frame zone. So we do have a coinciding level. But do we have multiple levels? Now you might say no, we don't have multiple levels. We only have one level, but you need to remember currently the indicator is only identifying quality areas on the lower time frame. But when we talk about cases of level on top of level, it is not mandatory that the other zones might be quality zones. So what I'll do is I'll change the indicator settings that I don't want to see only quality zones. I want to see all demand supply zone structures. So as soon as I click on it, you will see now the indicator will mark many more demand and supply areas for me, because now it is not just identifying quality areas. And now we have exactly what I was talking about. We have an intermediate time frame zone, which is right here, and you can see on the lower time frame it is getting divided into multiple zones, which makes it as a case of level on top of level. And since it is a case of level on top of level, what I should be doing now, instead of using the upper zone, I should be using the lower zone to have more probability stacked in my favor. So that is why it is important that whenever we do our qualification, we start with level on top of level first, because if some changes have to be made, we are making those changes before we start moving ahead. So yes, it is a case of level on top of level. We made our changes. Let's move on to the next one. Now, is the zone because of a gap? The answer is no, it's not because of a gap. Therefore, we need not apply the gap rules. Now, definitely it is a structure of pivot or non-authentic zone, because whenever we talk about drop-based rallies, we always consider them as pivot or non-authentic zones. But the rulebook tells us that when you have a case of level on top of level, so here you can see that in case of level on top of level, there is no need to apply pivot or non-authentic rules, as that extra probability that we are looking for, when we talk about pivot non-authentic zones, we add additional rules to increase that probability, and level on top of level by default is increasing that probability. So that is the reason in case of level on top of level, you can skip the pivot not authentic, and similarly you can also skip unstable equilibrium, but otherwise it's not a case of unstable equilibrium. So after looking at all these conditions, the only applicable one was level on top of level. Whatever modifications were required, we have made those modifications. After applying all the applicable rules, did the zone get qualified? The answer is yes, because none of these conditions, they disqualified the zone, and if they are not disqualifying the zone, by default it is a qualified zone for us. But still, you can't trade it blindly. Now the next step will be the booster scoring. So let's start with the boosters. So the first one is freshness. If you talk about freshness, you can see the lower zone has already been tested, but it's a very shallow touch, for which I can give it a score of 1.5. Talking about strength, you can see that I have selected all zones. If I remove all zones, the indicator is not identifying it, which means we don't have an explosive move. I can't even call it as a very good leg out followed by a nice follow through. It is still okay, right? So what I'll say is that if I give it a score of 0, it is almost like doing a little injustice, but fact is we can only give it 0, 1 or 2. So since we don't see a follow through pattern, I'll be giving it a score of 0 for now. Next, time at the zone, we had 3 candles in the basing, gets a score of 3. Reward to risk ratio, anyhow, we are taking as an assumption. Sorry, this will be a score of 2, not 3. So if you look at the overall scoring for quality, as of now, we have a score of 6.5, which makes it as a low quality zone. So now the question is, why am I even planning my trade on a low quality zone? And we'll again get the answer from the rulebook. So if you go to rulebook page number 107, we have additional rules where we talk about some of the characteristics of cases of level on top of level. Now remember, these 3 characteristics need not apply every time, right? At times one of them might be applicable, at times 2 of them might be applicable, at times all 3 of them might be applicable, at times maybe none of them is applicable, right? So do not assume that if I've given some characteristics, they need to apply. They might, right? But these are some of the characteristics you will see. So in case of demand, the lower zone might be tested by the upper zone. That is exactly what we are seeing, that the lower zone got tested, due to which this upper zone was formed, right? So that's our very first characteristic, which is definitely applicable here. The next rule says, sorry, the next characteristic says that in case of demand, the lower zone might be having lesser strength versus the upper zone, and we can also see that. You can see the upper zone is having a nice explosive move. The lower one is not even showing you a follow through pattern. So this one is also applicable. And the third characteristic is that in case of demand, the lower zone might have more number of candles versus the upper zone, and we can also see that upper zone has only one candle in the basing. This one was having about three candles in the basing, but at times, instead of three, it can be five, it can be six, it can be seven, it can be eight, right? So whatever we say are characteristics of a non-quality zone, that is what you might see in a case of level on top of level. But what you need to understand here is that when we talk about level on top of level basically implies that you are trading the intermediate time frame zone by fine tuning it on the lower time frame. So if you think about it, what I'm doing here is I have a zone on the intermediate which is weekly, and I'm basically trading this weekly zone. But if I was trading this weekly zone, my proximal would be here, my distal would be here. So my distal has still not shifted, but I'm now trying to get a little deeper into the zone and then take my trade, because I can see that the same zone is getting divided into multiple zones on the lower time frame. So we have simply just fine tuned it. So that is why when you see such a zone, you see these characteristics, you can ignore those characteristics. So you can see these characteristics can be ignored, and you can do the rating of the zone based on the intermediate time frame. So what that basically means is that now from the intermediate time frame I can do my booster scoring. But remember, the ones which have already got the highest score, you don't have to check them, because we are not downgrading, and since we can't upgrade, there is no need to look into them. The ones which did not have the highest score, those are the ones we'll be looking at, that can we upgrade them. So if you talk about freshness, you can see on this particular time frame, this is a fresh zone. After leaving the zone, prices have never been back. This gets a score of 3. And if you talk about strength, here you can see it is still better than the way we could see it on the lower time frame. So I can even upgrade this to a score of 1. So yes, we had a case of level on top of level. We saw some of the characteristics, and then we ignored those characteristics based on the rules we have in our rule book, and we were able to upgrade a low quality zone to a high quality zone. Now after the quality scoring, we will be moving on to the probability scoring, where the first thing we'll be checking is the location. Now if I go to the monthly chart, because on the higher time frame we do our curve analysis, you can see we have demand areas but we don't have supply, and the reason for that is no matter how far back I go, there is no price action. So this is where the all-time highs is for this particular symbol. So now if I don't have supply, I can't draw my curve. So what do I do in such a case where I only have demands, I don't have supplies to do my curve analysis? You have two options available. Option number one, you can say, okay, since I don't have supply to do my curve analysis, I don't want to analyze this symbol, let me move on to the next symbol, and you skip this one. That's the most conservative approach. The second one is again following a very logical approach, and that logical approach is, yes, I know I don't have any supply area, right? But if you look above from the current candle and try to find the most recent pivot high. So what do I mean by pivot high? The highest point from where prices have started moving down, the most recent. So you can see from here prices, they started moving down. Now logically we understand if the prices move down from here, there could only be one reason, and that one reason has to be supply. The only problem is that supply is not visible on this particular time frame. But if I go to some smaller time frames, I might be able to see that supply zone. So here you can see once I go to weekly, you do have the supply zone right here. So we understand supply has to be there, but it might not be visible on this time frame, but on a different time frame. So in such case, what I can do is I can use this highest point as a reference point and do my curve analysis all the way to the demand area. So the only difference now is that I don't have 5 different zones. I won't say zones, 5 different locations. I have 4 different locations, which are very low of the curve, low of the curve, middle of the curve, and high of the curve. Very high of the curve is missing in this case because we don't have a structure of supply zone. So this is how you can modify your approach, but you can still do your analysis. So now where am I located on the curve? Now here, this is where you can see that I'm partially located at low of the curve and I'm partially located at very low of the curve. So when your zone is overlapping two different areas, how do I decide? Should I call it as low of the curve? Should I call it as very low of the curve? The answer is very simple. We always understand the location from the entry point. Where am I entering the trade? That's your stop loss. This is not where you're entering the trade. So I am entering my trade at low of the curve location. So low of the curve will get a score of 1. Next is trend. So if I go to my weekly time frame, which is intermediate time frame, you can see the indicator is telling us we are in sideways because you have a down arrow and an up arrow, which means sideways gets a score of 0.5. Next is move from the zone. We need minimum 4:1, which has not yet happened. But yes, if the prices they move up and then start coming back, we can upgrade it to a score of 2. Currently, it will be a score of 0. It is a case of level on top of level. It is also a coinciding level. And for trap, also, I can give it a score of 1. And the reason for that is that if I take a horizontal line wherever my proximal is, and if you just look into this area, you can see in the past it has acted like almost resistance, acted like support, acted like support, acting like support, here also acting like support. So it's a decent kind of an area which is showing us support resistance on the chart. So what is going to happen now? People who believe in support resistance at support, they will be buying, and their stop losses will be placed below, and those stop losses will be sell orders. And similarly, if we have a breakout, then people who believe in breakout, they will also start selling. So we understand by the time we enter into this zone, we'll have a lot of selling coming in, and these people are now making two novice mistakes. Selling after a decline in price means selling at a cheaper price, and in an area where the chart has proven to us that back in history demand exceeded supply, which is the only reason for prices to move up. So yes, that possibility is there, which is why we gave it a score of 1. So if you look at the overall scoring, it's a high quality zone with a score of 9, and high probability setup with a score of 4.5, and high quality, high probability can be done as a type 1 trade. So after applying the boosters, we got to know it's a type 1 trade for us. Now the next challenge is, no matter how high the quality or the probability, any trade can be a stopped out trade. So we need to be ready for the worst case scenario, for which we'll do a proper position size calculation, so that in case the trade does not go in our favor, it goes against us, I should not lose more than what my risk management rule allows me to lose. Now, whenever the prices are back, you'll have to requalify. The reason is the markets are not static, markets are dynamic, conditions are changing almost every other second. So before placing your orders, you will always have to reinsure that it is still matching with your trade plan. If the answer to this, that does it qualify, is yes, you place your order. Once you get your entry, the last step is going to be your trade management. In fact, in this case, it is a type 1 trade, and last step is your trade management. And what do we do in trade management? Step 1, at 1:1, we make it as a break even trade, and after that, if we get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trades, very mechanically, very rule based, and that takes care of today's example, a very interesting example where we saw different aspects which are already available in the rule book. So it's a very beautiful example for today's session. Now, before I move ahead with the questions, queries I have in the chat box, I would like to add, if you people are liking these sessions, do ensure you hit the like button. And if you have any friends, family members, or if you're on some trading groups, you can also share the link to my course content, link to these videos, so that other people can also take advantage of it. And definitely, if you're not subscribed to my channel, do subscribe to my channel, so that whenever I do these sessions, you people get notifications for it. And if you're available, then you can join it live. In case you're not available, you can later watch the recordings as well. So let's see, what do we have in the chat box. First is, it's hi. All right. So hello, TKM. Hindi. So Rajesh, we have a separate channel for Hindi. It is called as Trading Munch. Again, if you'll go to the description, you'll find the link to that Hindi channel as well. So yes, I do take these sessions in Hindi, but it's on the other channel, which is exclusively Hindi channel. So you can subscribe to that channel. You can join that channel. That is where we'll be doing our analysis and everything in Hindi. All right. So next is. Volume is low, so I don't think, because at my end, my meters which show me how the volume is, they are showing me perfectly. Probably maybe you had your volume set down a little lower and nobody else gave that feedback. So I think it could be at your end, but yes, I'll later watch the recording and I'll see that if it was there was some issue with the volume. If yes, there was, then probably next session I'll fix it. All right, so can you please share your thoughts on speculation news on 30% tax on FNO? See, again, if the taxes are increased, then what is going to happen? The volumes will go down. That is the only thing that can happen. But again, whenever we are planning trades, the first thing is we need to ensure that we are only participating in symbols which are liquid enough, right? So yes, even if the volumes will go down, it's not going to go down on every symbol, right? Some future contracts will still have good volumes, those can still be traded. But yes, if you are getting taxed, then you will have to think whether you still want to trade into futures or you want to shift to cash. That is going to be your call. But yes, because of this, the only thing which can happen is the decline in volume. And I also saw somewhere that they are also trying to increase the lot size, right, to make it much more expensive as well, right? So those things can happen. But yes, all these things can only lead to the decline in volumes, specifically in those future contracts. Okay, so I have a question which is, can one trade more than one trade purpose? I'm thinking of picking. Okay, so what you're saying is, can we trade more than one purpose? Like, I'm also doing MIT, I'm also doing HIT, or I'm doing DIT with that. All right, let me read the complete question first. Picking few pairs of trade, split my trading view screen into MIT screen and WIT screen. Is it okay? Absolutely. See, it is perfectly fine. You can do that. But the only thing you need to remember is that when we go through our risk management rule, so let's assume that my risk management rule is that for a day, I don't want to take a risk which is more than 1%. Now, you know that you're planning MIT trades, and you know that you're also planning WIT trades, and you understand that when I plan my MITs and WITs, let's say on average, I get about 3 trades in a day, right? Combining both of them. So my 1% now should be split into these 3 trades, which I might get in a day, which means my risk per trade now should be 0.33%, because if I get all the 3 trades and all 3 of them they get stopped out, I'm not losing more than 1%. So by keeping that risk as a constant, yes, you can do a number of trades for a number of purposes. There is nothing wrong with that. All right, in one of your recent updates, I saw 2 different types of supply and demand indicator, one with alerts and one without. Is this an upgrade to the normal supply and demand indicator, or it comes with the alert package? Right. So see, we have 3 different tools as of now. The first one is just the demand supply zone indicator. The next one is our alert service. And the third one is our demand supply screener. So indicator is just standalone indicator. You only get access to the demand and supply zone indicator, nothing else. Now with alerts, you also get complementary access to the demand and supply zone indicator. But the one which you get with the alerts has the feature where you can set your custom alerts. And plus we also launched a new product, but we had to take it down due to some technical challenges. But we will be again making it live probably this week. So with alerts, you will get access to the demand and supply zone indicator with alerts. And once our new indicator, which is the demand supply zone alerts, is also live, you will also have access to it. And with the screener, again, you only get you get access to the demand and supply zone indicator in the screener. So alert, the demand supply zone indicator with alerts only comes with the alert subscription. It is not available as a standalone subscription. All right, so bank for Bank Nifty or NSA 100, why fresh zones are violating easily? Is it because of volatility? So see again, first thing is what kind of zones you're looking at, whether you're looking at really nice quality zones or you're just picking up any zones, right? That is one factor. Second factor is, yes, when the markets are moving in either direction, moving up or moving down. So if something is very strong, supplies will be easily getting violated. If the trend is changing now to a downtrend, demands will be easily getting violated. And again, just because you're doing demand and supply does not mean that every zone will hold. Zones will work, zones will get violated. In fact, you need to be very selective when it comes to uh, you know um, planning your trades. Now, just as an example, in fact, let me show you this. Just give me a second. Let me bring this up for you because we are on that question. Let me show you this. So what I'm doing is I'm just going through the list of some of the trade examples that I've shared with you in the past, and I'm just showing you how they work out, right? So some of them we have already reviewed, right? But I'm just going through them. So can you see this was the very first session for the year 2023. We never got a fill. It just kept moving higher and higher. It is still in my list because we have still not got a fill on this one. Next, you can see this one came pretty close to the zone. We definitely missed it. But from there, we got a move which was more than 3:1. But can you see we just simply missed it? So again, like you're talking about that, why are zones getting violated? Can you see some zones might get violated? Like this one got violated, but we never planned a trade on this one. We are planning on this one because you need to understand which is a quality zone and which is not a quality zone. Moving on to the next one, can you see this one was our session number 12 for the year 2024. Now, there might be zones in between, but we never pick those areas. We pick this one based on our plan. And can you see today you are trading somewhere around maybe 7 is to 1 or 8 is to 1. It came into our zone. We kept moving higher. As of today, you might be close to 7 is to 1, 8 is to 1. So it's not that zones they get violated. Yes, zones will get violated, but it's not that every zone will get violated. So the more selective you will be for finding your setups, the better will be your results. So that's your session number 12. So again, this happened later. So if you go to session number 12, you will see that, it might be something like this when we did our analysis. And this is after the prices they came into our zone. And that's the beauty of these sessions, that I'm pre-planning my trades. You can always go back and see what we planned, and you can always see the current situation, what happened with that particular trade setup. Let's see a few more examples. Can you see this was our session number 13 for the year 2024. We came into the zone. We got a move which was probably 6 is to 1. Currently, you're still trading above 2 is to 1 on this one. Let's move on to the next one. We never got the fill on this one. This is still pending. This is session number 18. Then you can see this is session number 20. I think we missed it here by a very small difference. And you can see we are moving up as of now, but the trade would have been missed, I believe, in this case. Now, this is your session number 21. Can you see we got a fill? Even today, you might be trading somewhere maybe close to 15 is to 1 or 16 is to 1. But can you see it came into our zone? That is where it started moving up. So again, if you are good with understanding what is a quality area, what is not a quality area, you can see the kind of results you get. But if you're randomly picking any zone and trying to trade it, you might not get very good results. Now, this is session number 22. You can see again, we came into the zone. As of today, we are trading a little over 2.5, so we are close to 3 is to 1. So here also you can see we came into the zone. That is where the prices they started moving up. So that's your session number 22 for the year 2024. That's your session number 23. Here also you can see the zone was not violated. In fact, the indicator will mark the zone for us. Even though our stop loss was a little lower, even the distal line was not breached. Currently trading a little over 3 is to 1. We already had a move which was approximately maybe 6 is to 1, but still trading above 3 is to 1. So that's your session number 23. Session number 24, we haven't been into the zone as of today. Session number 25, again, haven't been into the zone as of today. Session number 26, the same thing, haven't been into the zone. And today was our session number 27, where we are still waiting for prices to come into the zone. So the reason I showed you a few of these examples is for you to understand that every zone cannot be traded. You need to be very selective. Plus, you also need to understand that these ideas which I'm sharing with you, so I use my scanners, and every day I run my scanners. So I basically use the scanner. I run my scanner in all the 2000 plus companies. Out of it, whatever is getting shortlisted for me, then I match it with my trade plan. And that is how selective I am when I'm sharing these examples with you. So it's not that I'm randomly picking any symbol I'm sharing with you, because all these examples of which I'm showing you are the trades which I'm planning for myself. So I'm also taking those trades, and from those trades, I share those examples with you. So it's the homework that I'm doing. So few things that comes into play here is, one, you need to be very selective, and two, you also need to understand that yes, when you're being selective, what is a quality area, what is not a quality area. And when you start, keeping those things at the back of your mind, that I don't want to trade anything, I only want to trade something which is an exact replica of my trade plan, that increases the probability of your trade setups going in your favor versus having a lot of stopped out trades. So just because we were on that topic, I thought let me show you examples of some of these examples that we planned in the past and how some of them they played out for us. Now, many of them I've already removed from the list, and the reason for that is we have already reviewed them. So whenever anything gets triggered, we definitely review those trades as well. So some of the review trades has already been removed from the list. Some of them are still there because maybe I'm still trailing onto them, and that's still in my list, right? Because I might be in those trades trailing onto them. That's the reason I've still not removed it from the list. But yes, I just wanted to show you as an example that be selective. Don't try to jump into each and every zone or each and every script. And once you make that shift, in fact, this is a question which I ask a lot of people when they say, okay, a lot of my trades are getting stopped out. And the question I ask them is, okay, yes, I agree, a lot of trades are getting stopped out. But now my question to you is, let's assume you were risking, let's say, 100,000 per trade. So now if you were risking 100,000 per trade, will you still take so many trades? And the answer is no. Why? Because now you know that now I need to be very selective. Even if I take one trade, I get my 2 is to 1. I'm very happy with the results which I'm getting. But when you're trading a very small amount, let's say you're only taking a risk of 1K per trade. Now what happens at the back of your mind is, now I feel okay, I have to take at least 20 trades in a month, or I have to take 30 trades in a month so that I can make decent amount of money, right? So that is what forces you to start taking those trades. But you don't have to go through this path. What the only reason why you're starting with small is because you want to build that confidence. Once you have that confidence, you have to increase your risk per trade, take less number of trades so that you can make more money, right? So that's the right way to go about, versus just because I have a smaller risk appetite, I try to take too many trades, which is more like forcing yourself into trades. And the more you'll force yourself into trades, the more number of stopped out trades you'll be having. All right, so that takes care of our today's session. I'll probably be doing a session somewhere in between the week, because like I was talking about the latest tool that we have created, the demand supply zone alerts. I will be again, doing a session on it, helping you understand how it works, and then we'll be having another session at the weekend. All right, so a demand supply indicator works on all charts and US stock market as well. Correct. See, again, demand supply is a universal strategy. It can be applied to any time frame, to any markets, be that stocks, be that commodities, be that forex, be that crypto. So it's a universal strategy, can be applied across the board, any asset class, Indian markets, international markets, and that is the reason behind why I don't even share the name of the symbol, right? This could be gold, this could be Euro USD, this could be cryptos, right? It could be anything, right? The analysis will remain the same. It's a universal strategy. Any paid courses? So Yash, whatever you're learning here, exactly the same thing used to be my paid course. So see, this is what happens. When I used to take paid courses, people would say, okay, if you're such a good trader, why are you taking paid courses, right? You should be teaching for free. And now when I'm teaching for free, what happens is, do you have any paid courses? And the reason for that is, I knew this is going to happen. And the reason is because if you're getting something for free, people actually don't value it, right? So only when you're paying for it, that is the time people, they start valuing it. Otherwise, for the same course, I'll say about 3-4 months back, you would have been paying money to get exactly the same education. So that is where the challenge is. So do not assume that if I'm giving you a free course, you're getting anything less. The free course is exactly what you would have got in my paid course, right? So you're not missing on anything. So don't worry, I have taken care of it. That just because the course is free, you don't miss anything on it. And that is why I'll also talk about why, even if I talk about my indicators, I keep a very nominal chart, so that at least people, they understand they are paying something and they're getting value of it. Because if I make my indicators also free, it's going to be the same challenge. So that is how it is, right? If you give something for free, then people, they want paid. And if you're charging for it, then you get the question, why are you paying, why are you charging for it if you're a good trader and you're making money from your trades? Anyways, so let's not get into it. Let's see what do we have next. All right. Please reveal the name of the symbols for registered members. See, again, the name of the symbols I'll not be revealing, and the reason for that is that these sessions are not intended to give you ready-made trades. These sessions are intended for you to learn how to do your analysis all by yourself. I'm here to teach you how to fish. I'm not here to give you the fish, right? So that is the reason I have been getting this request a lot of times, but I'll never be doing that. I'll not be sharing the name of the symbols. You learn the process, apply it all by yourself. I am showing you the analysis beforehand, I'm showing you the results after it. That is how I'm trying to build up your confidence. Try to do it, practice it. See, it's not going to happen overnight, but yes, once you practice it enough, you can also get exactly the same results, right? So do that. Also include bullish and bearish engulfing for demand and supply. So I'm not very sure what do you mean by bullish and bearish engulfing, Samir. So what you can do is, you can send an email to info@Surjit with an example, maybe some screenshots, so that we can understand what you're referring to. And if we feel that it aligns with what I teach, we might add it as a feature into the indicator. But if it doesn't align with my approach, my strategy, then I'm not going to be adding it, because I want to create tools which are in sync with what I teach, right? So yes, you can still send it. I'll look into it. If I feel yes, it is something it can be added, I'll definitely do that. For POS, see, again, like I said, irrespective. So when you were a POS member or a POS Plus member, that is the time I definitely used to share the name of the symbols as well. But now we have shifted the way we approach it, and now I'll not be sharing the name of the symbols, right? So apologize for it. Let's see, right? Teach for free, not when it's taking time away from you. Yep. So that is what I'm doing, right? That is the reason I only do the sessions just once a week because, again, the reason behind why I take these sessions is, if you think about it, it's more like being connected with the community. Plus, because I'm teaching it, I'm actually revising my rules every other week, right? So that is the main idea behind, taking these sessions, because like I said, we need to be mechanical, we need to be rule based. So if I'm teaching it every other week, at least once a week, I'm revising my rules over and over again, over and over again, over and over again. So it's more like a selfish reason I have behind why I'm taking these sessions, to ensure that I'm not deviating from my rules, I'm also following my rules, right? So that is the main idea behind it. uh, Great. So, is there any community? So, we just recently started with a channel, but again, on the channel, you can't post anything. I keep updating, if there are some latest videos, or the schedule of these sessions, or maybe if there are any updates. But the reason I'm not starting with the community is because, see, at the end of the day, if you people are posting any questions, queries, my staff can't answer it. I'll have to answer it, right? And if somebody else is also posting, I'm not sure whether they are posting something which is correctly analyzed, or if the analysis is incorrect. So I don't want to get into all those things, because I know it will not be possible for me to review each and every post that we are getting in that community. That is the reason I'm not going through that, taking that path. I've learned many things today. All right, thank you. I appreciate that these sessions have been helping you. All right, great, perfect. So that brings us to the end of today's session. Thank you so much for joining in. I'll be seeing you next weekend now. Till then, trade safe. Enjoy your Sunday evening. Take care. Bye bye.